Hello, everyone joining. We're just about to get started in a few minutes. But while our presenters are setting up their PowerPoint, I do want to let everyone know that if you have questions, please use your Q&A functionality in the chat box. And then while we kind of, they're still getting it together, just to go over what we do at Shadow, we are a capital venture firm, or venture capital firm, excuse me, and our focus is on the built environment. So we are focused on all startups and technology that have a hand in the conception of a building to when it's being managed. So we kind of work with all startups and technology within that realm. And then while Amal is kind of still getting that together, Jonathan and Pablo, do you want to go into what you guys do and just a little bit of background on yourselves? And yeah.
Well, Kayla, I'll jump in. Thanks everyone for joining. I'm having a little user error here on sharing the presentation. Kayla, if you don't mind taking the lead on that,
yeah,
that'd be great. Suppose this is indicative of the era that we're in. But thank you all, everyone, for joining. My name is amol.naik. I'm at Squire Patton Boggs, which is a large international law firm, and I focus on public policy in the Atlanta office. I'm also a venture partner with Shadow Ventures. So thank you, Kayla, KP, everyone else for having us. Joined today by my colleagues, Pablo.carrillo and Jonathan.picard. Pablo and Jonathan, you want to do a brief introduction for yourselves?
Sure. Why don't I go first? Thank you, Mal, and thank you to Shadow Ventures. It's a pleasure to be here and talk with you today. So my name is Pablo.Carrillo. I'm a service of counsel in the Defense Public Policy Practice Group at Squire Patton Boggs in Washington, D.C. Up until about 3 years ago, I served as the Chief of Staff to the late U.S. Senator John McCain. I also served with them over a broader period of time, totaling about 15 years as his general counsel at the Senate Armed Services Committee, where I covered for him defense acquisition and procurement policy, with a particular emphasis on defense technology and dual use technology, which obviously implicates the venture capital community, the national ecosystem. So that's kind of part of my policy background that I've taken into my private practice. So it's a pleasure to make your acquaintance and look forward to talking with you.
Hey everyone, it's nice to be here today. My name is John Picard. I am a corporate partner in the firm's Atlanta office. My practice focus on investments, including venture capital and private equity. I do a significant amount of mergers and acquisitions work. I also do corporate governance and a significant amount of kind of day-to-day corporate requirements that companies run across, like entering into contracts with customers and suppliers, thinking through their supply chain, helping them think about issues with employees, and general corporate advice for things that come up to businesses as they come up. I'm thrilled to be here today, and I'd like to thank everybody for listening to us.
Awesome. Kayla, all right, there we go. Slides are coming. So we want to keep this really informal. The hope is that we're able to share our expertise to help you navigate some of the challenges that we're all facing at the moment. It's really an unprecedented time, and we really have some great guests here with Pablo and John to help us navigate those. I'll also say I should share a little bit about my background. I've just joined the firm about 3 months ago. Prior to that, I was the Chief Resilience Officer for Mayor Bottoms at the City of Atlanta, where I ran her public policy shop. And before that, I spent 7 years at Google, first starting in Washington, D.C., helping establish Google's D.C. presence. I was a much smaller company, and then came back down to Atlanta to do public policy and government affairs at the state and local level. So we have a broad range of expertise here that's hopefully helpful. So Kayla, if we could go to the next slide. So, of course, please mute during the presentation. We're going to do questions through the chat function, and we also have a poll that I think has just popped up. If everyone sees that, if you could answer that poll, that'd be super helpful, so we know sort of who's on the call and what would be most helpful. All right, Kayla, do we have the results?
We do almost. There's still a couple of people, but it looks like the majority are other, and then the other two that are kind of tied are venture capital and private equity as
Got
far
it.
as backgrounds.
Okay. Is there a way to publish this so everyone knows who all's on the call?
I will figure that out.
All right, no worries. If not, we can go to the next slide. So this is just a little bit about our firm here and what we do. Global law firm, over 1,500 lawyers in 45 offices in 20 countries. So we can go to the next slide. As you'll see, we really cover the gamut on every industry possible. Here on the call today, we've got the public policy team and corporate team represented, and Pablo also has the national security expertise that he shared here. So again, look forward to taking your questions here in a moment. We can go to the next slide. And here's a list of all of our offices. Go straight to the next one. And here's some really good pictures of us, except for myself. I'm going to redo that as soon as I get back to the office. Next slide, please. We just wanted to set the stage a bit here in terms of what we're dealing with, right? So the CARES Act, which Pablo will get into in much more detail about, is the largest. And it's an unprecedented, unparalleled economic rescue package. This is from the Chicago Tribune after the Senate passage. I thought was really illustrative of what we're at the moment. And it's just an unprecedented injection of capital into the American economy. And with that come so many challenges. So there are a number of programs being released by the Small Business Administration, Treasury, Federal Reserve, and others that in a normal time, which we're certainly not in at the moment, would have had months, if not years, to form and launch. Now we're doing this in a matter of days. And so Pablo, John, and I, as we're advising clients, are really seeing developments on an hour-by-hour basis on these massive programs. And so we understand that could be very difficult to navigate. And so we're very happy today to go through some of the various challenges and opportunities that are also here. I think our poll results have popped up. Looks like we've got a good bit of diversity in who all's on the call here. So we can go to the next slide. The four primary policy considerations, and then we'll let Pablo get into this. There's this a program that I'm sure all of you have heard of called the Paycheck Protection Program. It's been getting a lot of media coverage. Those funds were really exhausted in a very quick time frame. Hopefully was able to provide some relief to some of you on the call today. That is really for payroll payments, as its name would suggest. And it is a forgivable loan. So it is something that we think has been of significant interest to small business. There's also the Economic Injury Disaster Loan Program. That's changed significantly in recent days, but that also may be an avenue for folks now that are currently in the agricultural space. There's a larger facility and grouping of loan programs, generally known as the Main Street Lending Program. And those are really for businesses of over 500 people. And there's some some challenges and opportunities there. And then the last one, which I'm excited to hear more about, is the USXM Bank, which is an entity that not a lot of people know about, but really could have some opportunities, especially for folks in the startup space. So Pablo, with that, I'll kick it over to you.
Thank you, Mal, and I appreciate it. And I would just wedge into that one thing I'd like to talk about as well, particularly with regard to those of you that are developing what are called dual-use technologies, technologies that are used in the civilian sector, but that may be also used by the military. So AI, ML, maybe in your domain, I'm trying to think. It could be robotics. It could be, smart types of smart city or smart building types of technologies. There may be opportunities within the DoD. So just kind of wedge that in just a little bit. So if we could go to the next slide, we'll get into the presentation. Just one quick important note with regard to the PPP loan. I'm going to assume, because we're so far into the life cycle of these programs, that you guys are probably familiar with the programs generally. If not, I'm happy to talk about them in greater detail. The PPP loan, as Amal described, was intended to help support the cash flow needs of small businesses, to help them keep employees on their workforce. And to the extent that those loan proceeds are used in particular for intended purposes, which include payroll costs, but other categories of costs, those loans may be forgivable. Would be forgivable at the end of the day, with the caveat that of all of the loan proceeds that are extracted, only no more than 25% of that total amount can be used for non-payroll purposes, and those non-payroll purposes are not forgivable. So once again, that's kind of the overarching structure. The big deadline today, you may or may not know, particularly those of you that may have already taken out PPP loans. There is a deadline for you to return those loan proceeds. Let me back up for a second, because this is important. Once again, this is a deadline that exists today. Just a few weeks ago, about a couple of weeks ago, on the heels of some high-profile negative media reports about quote-unquote abuses by, in particular, large publicly owned companies or other business concerns that arguably have access to dry capital. They're taking out large amounts and being approved for large amounts of loan proceeds under the PPP program. Secretary Mnuchin stated publicly, and this was followed by Treasury Department and SBA guidance, said that companies like this should not be taking out loans, PPP loans. So with that in mind, the Treasury Department issued guidance a couple of weeks ago, that basically said that you have to certify as a borrower to the economic necessity for having taken out the loan in the first instance, and the fact that you actually need to keep the money. So, and that's a new requirement that does not arise under the CARES Act. In fact, there are provisions in the CARES Act that do just kind of the opposite, actually. But in the face of these high-profile cases, this is a direction that the Treasury Department wants to move in. So under this new guidance, if you've taken the loan and been approved, or you've gotten the loan proceeds and you really didn't need the money and you can't certify to economic necessity, you've got until today to return the money to the Treasury Department and be deemed to have conducted yourself in good faith. So other than that, there frankly is not a lot of guidance. I'm happy to talk to you more about that. Some of you guys may be in that position already, so happy to talk with you about that. But that deadline, once again, is today. So with that, we'll dive into the brief. This is of no surprise that, like the rest of the economy, the COVID-19 pandemic really threatens to impair significantly VC financing. There was some of the studies that we've seen in connection with the 2008 recession and financial downturn suggest that the recovery here is going to be a long, hard slog. Fundraising for VC funds fell 52% in 2009 after that recession, and didn't recover to their pre-2008 levels until 2015. At this point, there's no reason to expect a significantly different result in connection with the economic downturn associated with the pandemic. From what I can tell, having spoken with a lot of you guys in various ecosystems throughout the country, in particular Silicon Valley, it's my sense, I'd love to get your sense of this as well, but it's my sense that the federal COVID-19 rescue efforts have largely left the VC community behind. You guys have seen in the media reports about how the PPP program in particular has been fraught with controversy and has generally not been helpful, particularly to dual use venture startups. There's been a lot of confusion about whether or not the applicability of the SBA's affiliation rules per se ding or disqualify venture-backed companies from participating in the PPP program. The answer is no, and I want to talk about that in a little bit. It requires some analysis. It's not necessarily the case that the applicability of the SBA's affiliation rules per se disqualify venture-backed companies from participating in the program, but there seems to be this view out there. As a result, a survey taken by the Silicon Valley Defense Working Group that just came out just yesterday actually found that 2/3 of dual-use startups passed on PPP loans due to their sense of the affiliation rules and how those rules apply to them. So with capital drying up, VC-backed startups are in trouble. So according to the Industry Venture Survey released on April 21 of this year, 44% of these companies have less than 12 months of cash on hand to fund operations. So in the face of the VC markets being private VC markets being frozen up, it seems that dual-use startups have some combination of three options to save or support their business: significantly lay off staff and reduce research to extend their runway. Number two, expand their search for capital to include foreign investors. Or number three, look to foreign sources of liquidity, which we'll talk about shortly. In venture option number one, obviously we leave to you. That's a fact-sensitive inquiry requiring your best business judgment. Option number two, looking at foreign sources, particularly at this time, may be a bit difficult. There's the CFIUS, the Council for Foreign Investment in the United States. The authorities, is a multi-agency effort that looks at foreign investment in U.S. companies, particularly those that are developing foundational or emerging technologies. That law that organization, the organization's authorities were kind of beefed up to make sure that no national security concerns are implicated through those transactions. Coupled with the fact that, and you guys have probably seen some stories about this, but there's a good amount of concern, particularly on the Hill, that Chinese shell companies in particular have been buying equity interest in startups, particularly technology startups, in a way that's once again gives rise to national security concerns. So foreign sources of capital may be an issue. Number three is is what I really would like to focus on today. I'm going to focus on two prongs there. So want to talk about the affiliation rules and kind of try to disabuse this notion that the affiliation rules per se disqualify venture-backed companies from having access to the PPP program. Then I want to talk about so we'll talk about that's PPP. Not really going to get into EIDL, but happy to answer questions on it. PPP is the far more attractive of the two because PPP, it's the rate of interest is 1%. The term of the loan is 2 years, and as I mentioned, there is an aspect to that program that actually makes the loan forgivable at the end of the day. The other credit facility, as Amal referred to, is the Main Street Lending Program. Once again, not really going to talk about that. Amal described it in broad terms. That program is not yet rolled out it may be one that's more appealing for venture-backed companies, or in particular PE-backed companies. But we're happy to talk about that in greater detail if you would like. But that is yet to roll out. In testimony yesterday, the chairman of the Federal Reserve told Congress that he did not expect the Main Street lending program to be rolled out within the next few months, which is obviously raised a lot of concern on the Hill. So the two other federal sources or potential business opportunities I would suggest to you may lie with the DoD, particularly those of you that are developing dual-use technologies, and the Export-Import Bank of the United States. So let me first very quickly talk about the affiliation rules. This is the next slide. The kind of the bottom line up front is, I'm sorry, the next slide, Amal, or Kaylee, thank you. The kind of the bottom line up front is, whether a given venture-backed company is eligible for PPP loan is in fact a fact-sensitive inquiry. It's not. There's nothing about the applicability of that rule as it relates to venture capital-backed companies that disqualifies those companies per se. It in fact is a fact-sensitive inquiry that turns on the issue of control. As in any PPP case involving interlocking ownership and control, where no single investor has a majority ownership interest, the affiliation rules under the SBA, rules and regs, and what's called the interim final rule on affiliation, particular to the PPP program, apply. With that in mind, what one has to do is you have to do a facts and circumstances test to see whether any minority shareholder, in this case a venture capital investor or sponsor, has quote unquote control sufficient to be deemed an affiliate for purposes of the rules. If it does, then the number of employees that the affiliate has would be added to the number of employees that are employed by that startup, and then you would set that up against the size standards under the SBA rule or under the PPP. For the PPP, generally, it's 500 employees or less, or if you're in the or if you're a franchise, or if you are in the restaurant or hotel business, then only the number of employees at a given location applies, as opposed to all of the employees that are employed throughout the company. But in the case of VC-backed companies, once again, the affiliation rules could apply where control is found to add all of those employees employed by the affiliate company of the venture capital sponsor to the prospective borrower, and then once again you would compare that against the size standards under what called the NAICS code, industry code, or the particular rules under the PPP. Once again, being 500 or less. So the issue of control itself turns on the question: can an investor, under the entity's articles or charter or its bylaws or operating agreement, in fact control that business, that given business concern? If a minority investor may, in this context, may be found to have negative control if the business confers on that investor the power to block action by its management or majority members. So at that point, if you need to inquire into that issue, the issue becomes, well, what's being blocked? What kind of actions are being blocked, and does such management actions that are being blocked by the minority investor confer control for purposes of the affiliation rules? So at that point, you would just basically look at the facts. This is the next slide, please. So I'm at the third slide, the third bullet in this slide. So basically, what you would do is look at the facts of your particular case and see whether or not the business is giving the minority shareholder, in this case a VC sponsor, the ability to block a certain to block certain management actions. Once again, how does that measure against that test? There's case law that says that with a particular, with regard to certain types of quote unquote extraordinary actions of the business, that the ability of the minority investor to block those types of actions actually don't provide for negative control if those provisions were crafted to protect the investment of the minority shareholder or shareholders as a class, as opposed to the types impeding the majority's ability to control the businesses, the concern's operations, or to conduct the concern's business as it chooses more fundamentally. So the bottom line here is that you need to consult your organizational and governance documents, see how it relates to the rights of minority shareholders, including venture capital sponsors, and set them against applicable case law, interpreting the regs, and see where you land. This will probably require the assistance of a lawyer. This is the kind of advice that we provide our clients all of the time, particularly when you dive into the decisions of the Office of Hearings and Appeals at the SBA, OHA, which has actually developed a decent amount of jurisprudence or case law on this that we could consult to see how you come out on the other side of it. So the bottom line is that you are not per se disqualified from participating in the PPP program if you are a venture-backed company. By contrast, on the other hand, what you need to do is conduct more of a fact-based inquiry on the issue of control and see where you land. So, so with that in mind, we'll turn to the next page and talk about possible opportunities with the DoD. You guys know more so than most, Atlanta, I mean, obviously is part of that ecosystem into which factors prominently Georgia Tech, which is obviously one of the foremost UARCs in the country, unaffiliated the research centers associated with the DoD. So some of this information might not be new to you, but it might be new to some of you all. Over the last 15 or so years, of course, as you know, much of the technological innovation that's occurred in this country has been done by purely commercial companies, not by the DoD, not by DoD affiliated research, university research or otherwise. And a lot of obviously the tech titans that we now see are a legacy of those efforts. With that in mind, over the last 5 years in particular, the DoD has set out for itself a policy of relying on these sorts of commercial companies, which include venture-backed commercial startups, as sources of technologies that it needs to have continuing access to in order to remain technologically dominant over future adversaries, in particular the Chinese. So over from 2014 to 2018, the DoD investment in commercial startups developing dual-use technologies that align with DoD R&D priorities, AI, ML, quantum and advanced computing, hypersonics, certainly space-related technologies. Those investments increased from about $5.2 billion to about $15 billion, constituting about 20% of overall investment in startups in the United States, with most of those investments by the DoD being made in A and B series startups. So we've seen historically, a pretty good commitment by the DoD in supporting a lot of what you guys do. Unfortunately, as I mentioned at the front end of the discussion, the pandemic's thrown quite a monkey wrench into that. That being said, it's certainly my clear sense that the DoD and DoD leaders are focused on developing this portion of the national security innovation base, rehabilitating it, if you will. So particularly using and I think we can go to the next slide, relying on the number of innovation units that it has stood up over the last 5 years, originally with DIUX, now called DIU in Silicon Valley, but also Army Futures Command based in Austin. DIU also has an outpost in Boston vis-a-vis Harvard and MIT. The military departments themselves have innovation units that you would be able to do business with. Special Operations Forces, SOFWorks, AFWorks at the Air Force, the Senior Acquisition Executive of the Navy, Hondo Gertz is, with regard to the Navy, is really at the forefront of exploring the technologies that folks like yourselves are developing and seeing how they can be used, they can be leveraged for use by the Navy. So there may be some really, really interesting opportunities out there. And indeed, that's one of the things that we do with our venture capital startup clients, as well as PE-backed clients. So once again, that may be a particular a segment that might be of interest to you, and certainly we at Squire Patton Boggs in this context, would support you guys and support our venture capital startup clients in a variety of different ways in this context, from government contracting to IP to if you're developing software, there are going to be cybersecurity policy implications about what you do, negotiating T's and C's with the government, locating and helping you participate in what's called OTA consortia, which is how the DoD typically interacts with the ecosystem, with the national ecosystem. So lots of ways where we can be helpful with you there. So I'll conclude with an observation about the Export-Import Bank. Next slide, please. The Export-Import Bank, you guys may or may not know, called EXIM for short, is an independent federal agency that's charged with supporting U.S. exporters in the global marketplace to maintain global competitiveness of U.S. exporters. Unfortunately, over the last years, there's been quite a political debate about reauthorizing it. And fortunately, at the end of last year, that debate came to an end with Congress legislating, in rather historical terms, the Export-Import Bank for XM for the next 10 years. As part of that reauthorization, the XM Bank Congress required XM, and XM is indeed going about doing this, is advancing U.S. leadership in the world vis-a-vis China and supporting American innovation through the support of U.S. exports by standing up something called a program on China and transformational exports, the China program for short. It's amazing how few people really know about this program. Under this program, XM will reserve not less than 20% of its total financing authority, equal to about $27 billion in support for U.S. exports to compete with China in specific technology sectors. Next slide, please. Those technology sectors include a lot of the types of technologies that we would typically regard as dual use. So renewable energy, wireless communications, and including 5G, biotech, biomed, semiconductor technology, AI to ML, high performance and quantum computing, also water treatment and sanitation, emerging financial technologies, and XM is added to the list, space-related tech, including satellite technology. So the bottom line is, if you operate in one of these sectors, and if you're interested in exploring international commercial sales and would like to explore how XM could be helpful to you, either in the context of the China program or even outside the context of the China program, we'd love to talk with you and get you vectored into those initiatives aggressively. Our relationships with XM's leadership from the top on down are excellent, and we can say, with high degree of confidence that the appetite that we're seeing from XM's leadership to finance deals that help U.S. technology companies compete globally is very strong and very conducive to supporting you guys in that marketplace. So hopefully we've identified some problems and some possible solutions where we may be able to be helpful to you in these very troubled times. So with that, I'll throw it back to Amal.
Thank you, Pablo. That was really good and very helpful. As three things just kind of stuck out to me as you're going through all that information. One, just how much information there truly is. I mean, again, unprecedented response by the federal government to prop up the economy during an unprecedented time. And so there's a lot of challenges, but as Pablo outlined, there's also a lot of opportunities. Two is, again, there's avenues that the media probably has not focused on, such as this U.S. XM Bank, $27 billion available, right? That really could be of use to any number of you all who are in these spaces that are highlighted on the screen above. And third is just the challenge, frankly, in complying with all of these. I think we have a Q&A question about PPP compliance that we can get to after John's presentation, but there's significant challenges with accepting this sort of federal money as well. So Pablo, thank you so much. That's super helpful. John is a corporate stated in our Atlanta office and works with a lot of companies of all sizes, and it's going to give you some best pointers on sort of how to deal with a number of the challenges that are facing the corporate community at the moment. John?
Yeah, thanks, Mo, and thanks, Pablo. So I'm going to spend a little bit of time discussing some more kind of high-level general considerations that every early stage and mid-market company should be considering, especially in this challenging economy. First, we'll talk a little bit about capital, spend a little bit of time talking about customers and suppliers, and finally kind of wrap it up with thinking about your employees and how the relationship with the employees might be changing right now. So to kick it off, capital, money, no surprise to anybody, cash is king. It is absolutely critical that you have access to sufficient cash to continue operating your business. You got to think early and often about your current cash position, your expected cash needs, and what access to cash you're going to have in the future. When you're thinking about cash, a lot of times we start at the top with equity capital. It's important to understand kind of what the relationship is with equity capital right now. What is in place currently? Do any investors have an obligation to make additional investments? Is there a contractual obligation to contribute more? Do your current investors have the ability to make additional investments? Is there dry powder? Is there cash on hand? Are they interested? Or are they also experiencing challenging times and that's not going to be a source of capital in the future? And start thinking now, even maybe before you need it, if you need to raise capital, where are you going to go to get it? Also, as businesses face challenges, it's important to understand what shareholder rights are in place. What have you granted to your equity holders? Company valuations are down across sectors, and sometimes as those valuations go down, additional shareholder rights can be triggered. You'll want to know what rights do those equity holders have? Do they have affirmative control rights to require the company to take certain actions? Do they have blocking rights? How do those rights affect the operation of the business? Just know what's out there. And then also, what are the investor's rights in down rounds, right? The investor might have made an investment in good times. And the next investment, whether it's from that investor or from a new third-party investor, might be for a lower valuation. Are any rights triggered? How does that affect the rights of existing investors? And I'm thinking about another piece of the capital chain, and this is probably especially for businesses that have existing loans, existing credit facilities. What are the terms that are in place right now? You need to know those credit agreements. You need to know what covenants apply, and you need to do your best to model whether or not the company is going to be able to comply with them. If you have convertible debt, understand how the performance of the company right now and the expected performance of the company is going to affect the features of conversion. Is it unlikely that it will be converted? Will it be converted at a lower valuation? And how will that affect the capital structure of the business? With any lender, it's important to stay in contact with them right now. I know a lot of businesses are super focused on just surviving. And so all you're doing is trying your absolute best to get through each day. But it's important to think about this in advance. Stay in contact with lenders. Let them know how you're doing. Let them know what your expected needs are going to be. Don't surprise them with issues. If you're not going to meet obligations, you shouldn't let them know once you've already failed to meet it. A lot of lenders, surprisingly right now, are actually pretty willing to help. They recognize that businesses are going through trouble. They don't particularly want to have to exercise rights remedies to come in, and they want you to continue to operate the business. And so everybody in the world right now is getting creative on solutions, including lenders. Related to capital and related to investors, it is absolutely critical right now that you understand and remember your fiduciary duties. The most significant fiduciary duty that is implicated in these challenging times is the duty of care. The duty of care requires you to make decisions in good faith and in a reasonably prudent manner, using your business judgment to act in the best interest of the company. That duty flows largely to the shareholders. It's ultimately to the company, but largely for the benefit of the shareholders. But importantly, if you're insolvent or if you're becoming to face a situation where you may be insolvent, the duty also can extend to the creditors. Sometimes it is a challenge to manage that duty as you near insolvency, because shareholders want to take action to preserve their value, creditors want to take action to preserve their value, and officers and directors can be in the middle. So know your duty, know what you have to do, understand that existing stakeholders might have conflicts, but that's something that you're going to need to manage and something that your legal advisors can certainly help you do. As you're thinking about complying with your fiduciary duties, one of our recommendations for best practices is to document everything. Document the facts and circumstances that are happening right now that are leading to you make decisions. Document what information you're relying on to make your decisions and the actual decision made. That process is a good corporate governance pointer in general. It forces you to think really hard about what you're doing and why you're doing it. But it also provides some protection in the event that anybody ever comes back and challenges the decision you made. All right, so moving on now to thinking about your relationship. Kayla, you can go the prior, or Molly, you can go the prior slide. There you go, yeah. Thinking about your relationships with customers and suppliers. So a theme of my conversation today is know your agreements. Understand what's in place right now for customers. Understand your rights and your customers' rights. What are their payment obligations? What rights do they have to terminate the agreement and the relationship, and when and why? Can they terminate anytime they want for convenience? Are they obligated to perform for a certain amount of time? What are their payment obligations? And then importantly, what happens if they breach their obligations, right? You deliver your product or your service or your good and they don't pay you. What are your rights and remedies? And also too, answering kind of the looser factual question, what are your real rights and remedies setting aside the agreement? Is there any money behind this customer? Is this a big company that is creditworthy, that has access to capital? Is this a small customer that's a couple folks in a shop doing their best and there's nothing behind them? It's important to understand what's the actual likelihood of being able to collect if that customer doesn't perform. Similarly, thinking about suppliers, understand your agreements, understand what their obligations are to deliver. This is true for both actual suppliers of goods and products, but also for consultants, service providers, if you're purchasing software, anything in your supply chain, anything that is necessary for you to continue operating your business, it's critical to understand what their obligations are to continue to provide that to you. Similarly, you need to understand what will you do if somebody fails, right? So not just the person or a party providing the product, good, or service to you, but all of the folks and all the businesses that go into providing what that service provider needs to provide its service. Every link in your supply chain is critical, and you need to know what to do if one fails. How can you replace it? How can you replace that good or service? Where do you go? Also with suppliers, right now is a time to consider whether or not to renegotiate. Your customers might be coming to you to renegotiate prices. It's totally appropriate to go to your suppliers to renegotiate terms and prices. Suppliers can extend payment terms. They can provide supplier credits. They can lower prices. They can provide incentives. Circling back on the theme, cash is king. Anything you can do to preserve cash is valuable. A lot of suppliers are willing to work with you on that. Similar note, cash is king. Talk to your landlords. Some landlords are being really fantastic right now. Some are being a little bit more challenging. But some landlords are able to provide some rent relief in forms of abatement, forbearance, decreasing rent. look at your lease, see what the terms are in the event you're not able to be in your space right now because of work from home requirements. There are a lot of actions you can take that ultimately lead to being able to reduce that real estate expense.
Great.
And I know we all want to have a little bit of time to ask questions, so I'll just hit real quickly on the last couple items, is thinking about your employees. So in these challenging times, a number of businesses are going to be forced to make furloughs or layoffs. Again, the key thing to know here is, what are your obligations? Do you have contractual obligations to your employees, like severance payments? Do you have other legal obligations to your employees? Whenever you're thinking about laying off employees, you should think about whether or not any statutes are implicated. Things like the Warren Act or similar state statutes that apply when you're laying off a significant number of employees. And of course, like any termination of employment, you still have to comply with all of the obligations that the law requires, like not terminating employees in a discriminatory manner. As your employees are working from home, you should think about what policies and procedures you have in place to ensure that they're working in an appropriate manner and set expectations. You should also be thinking about what data privacy concerns are implicated by working from home. So many businesses have been forced to let their employees work from home in a manner they never had before, and they weren't necessarily ready. And so think about what additional data privacy risks there are. And finally, when you're thinking about employees, it's important to remember that even in the challenging times, you have to incentivize them to perform. And if employees have stock options, profit participation awards, equity incentives, bonuses, that a lot of those are going to be underwater and not likely to be achieved. And even though the business might be having some challenging or struggling times, you want to continue to incentivize each employee to do their best job. And think about how you can do that right now, taking into account the current economic circumstance. So with that, I will turn it back over to Amol. And I think, Amol, you might want to open it up for some questions.
Absolutely. Thank you, John. Super helpful. Again, sort of our underlying theme stands with John's comments, which is unprecedented times and sort of unprecedented action, right? So one of the key takeaways I had there was, if you're having financial challenges like so many businesses are, don't wait for it to be a problem before contacting your landlord, your lender, or whomever else, because there are entities that are much more likely to negotiate with you on favorable terms now, understanding the circumstances than might be the case in other times. So thank you for that, John. So we've got a bunch of great questions here. And I know a lot of folks will be watching this as a recording as well. So we're going to try, we got about 10 minutes. We're going to try to get through as many of these questions as we can. And for those who are watching this on a recording, and the questions we don't answer, if the Shadow Ventures team could make our emails available, we will be happy to follow up as appropriate. So let's go to the first question here, which is can you comment on any risks to loan recipients if the PPP certification necessity was truthful and in good faith when made, but circumstances weren't as bad as initially thought in the weeks and months that followed? The world was freaking out when this all started, but in some sectors, maybe less so today. It's a good question, very timely with today's deadline. Pablo, do you want to give an answer to that?
Sure. Great question. That's kind of the $2 million question, isn't it? One reason I say $2 million is because, as you may not know, Secretary Mnuchin originally said that if the amount that you took out exceeded $2 million, that you're going to get audited. There will be a final review or I think he said final review or another review undertaken by SBA. In guidance that was released by Treasury, I think it was just yesterday. The question was, well, is that a bright line or it isn't? It looks like it is. It looks like if it's $2 million or above, there'll be a mandatory review by SBA. If it's below $2 million, it's not mandatory, but it doesn't necessarily mean that it won't be reviewed. That having been said, unfortunately, trying to be directly responsive to your question, there is and this is a rather consistent theme with regard to the CARES Act generally, but there's very little in the way of guidance on what constitutes economic necessity. You may or may not know, in the rule on this issue, rather than providing any guidance that could be generally applied in a number of different fact patterns, what Treasury did is they actually did the opposite. They said, if you're a publicly traded company and you've got a decent amount of money and you have sufficient access to the capital markets, the likelihood is that you will not be able to make a showing of economic necessity. And actually, on that basis, a lot of venture capital backed companies, and certainly PE companies, but PE-backed companies get dinged on affiliation, but venture-backed companies raise their antennae. Does my mere access to capital from my venture capital sponsors, is that sufficient for me to not to be able to show economic necessity? The question of that is really, really unclear. So what I can tell you or suggest to you that may be a source of comfort is, if you choose to keep the loans, there are things that you can do to make sure that you're, if you will, ready for audit. And I have to give you some suggestions in that regard in just a second. But also, if your facts are good, as you suggest, that's implied in the fact pattern, the SBA's full remedy is simply asking for the money back, and without the imposition of penalties. Where you get into problems is if it's an egregious case and the borrower it doesn't want to return the money, chooses to contest it, or something like that. So, and obviously, if the SBA finds that that a statement was made and this was not part of the question, but falsely, then you may get there may be liability under the False Claims Act. So this might be helpful as well. In order to make sure that such a review of your desire to ask for the money and keep the money in good faith is successful at the end of the day, we would certainly suggest that you work with your management and your board to review those factors relevant to that good faith determination of necessity by looking at your balance sheet, cash flows, access to additional capital and terms of such capital, an analysis of the business as a going concern, financial forecasts, a budget and business plan, planned head counts, and the economic need for the loan and its impact to business to the business and its operations, and then determine and document whether there exists a reasonable fact-based basis to support the certification that you made or will make for obtaining and indeed keeping the loan, and making sure that that's memorialized and producible to SBA should they inquire about it downrange. My final comment about this is you may or may not know the audit and oversight infrastructure that is out there with regard to the issuance of these loans and the use of these proceeds is unprecedented, even in terms of TARP or the American Recovery Act in 2009 in reaction to the financial downturn back then. You've got at least 6 entities: Special Inspector General for Pandemic Recovery out of the Treasury Department, Pandemic Response Accountability Committee, organized by an organization of inspectors general called the SIGI, a Congressional Oversight Committee on the crisis, basically a 9/11 committee style entity, the House Select Committee on Coronavirus, the coronavirus crisis, headed up by the the Deputy Majority Whip, Congressman James Clyburn, the SBA Inspector General, and the Small Business Committees in the House and the Senate. So the certification only goes to the SBA and the SBA's ability to refer the matter for further investigation to justice if warranted. But all of those others are still out there. So you'd have to factor that into your calculus as well.
Great, thank you, Pablo. That's super helpful. I mean, the oversight here is significant, and there was one particularly egregious case I know here in Atlanta where the U.S. attorney actually went after someone who clearly made or appears to have made some fraudulent claims and misused PPP funds already. John, there's a question specifically for you. Have you seen any startups trying to renegotiate safe note caps due to valuations suddenly being lower than they expected when they took the note?
Yeah, I haven't seen it yet, but I wouldn't be surprised to hear about that. I think, like we were talking about, these are unprecedented times. Kind of everything is on the table. So it hasn't come across my desk, but I would not be surprised to see it.
Great. There's again, several good questions here running up to 1 o'clock. Certainly happy to follow up with folks afterwards if helpful. I think one that would be particularly interesting to folks perhaps is, Pablo, what does the process for getting in the EXIM program look like, and how do they make the decisions?
A terrific question. So let me back up and not assume that everyone knows how XM can in fact be helpful to you. So basically, they have among lots of instruments they can be helpful to. They can help you with. They can actually do direct loan underwriting, but what they actually do a lot of is risk insurance. If you want to export to a country that may have some political issues, they're able to underwrite that risk to make it commercially appealing for you to get private financing, and underwriting risk and direct loans, in cases where they're not competing directly with commercial banks. You would follow, and certainly we would be happy to help you do this. They have a really great deal teams on everything from transportation infrastructure to space to energy to biotechnology, and you would just, we'd help you set up a meeting and draft a proposal. And fortunately for us, we happen to have one of our partners used to serve as the general counsel for XM until fairly recently, and it's got a really, really good sense of how to do this very, very powerfully. And you'd ultimately develop a term sheet, and they'd help you pull the deal together. And they do very, very big multi-billion-dollar deals, and they also do deals for small business. And they are very interested in venture-backed companies, by the way, particularly in these emerging technology sectors. So a very, very user-friendly environment for you to explore.
Great. Well, we are at 1 o'clock. I'm sorry for the questions we weren't able to get to. Thank you to the Shadow Ventures team for having us. And we'll leave on the hopeful note of opportunity there with XM, and are certainly happy as a firm to follow up to any questions you may have here. So thank you all. Thank you, Kayla, for having us. We really enjoyed it, and hope everyone has a great day.
Thank you, Amal, Jonathan, and Pablo. Yes, this was recorded, and for any of you in the community, Amal is in Slack, and we'll also be in touch on how to get in touch with you guys. So thank you, everyone.
Thank you, guys.
Thank you.